90% of new trucking companies fail in the first year. And the number one reason isn't bad freight or blown engines, it's cash flow. But here's the part nobody talks about. A huge chunk of those failures had access to financing they never got because they didn't know what the lender was actually looking for. They applied with half a file, got denied or delayed, ran out of cash waiting, and closed. Today, we're going to walk through every financing product a trucking company can use, exactly what each one requires, and the mistakes that turn a 48-hour approval into a 3-week nightmare. Or a denial. If you run trucks, this might be the most important episode you listen to this year.
Yeah, that devastating cash flow trap is exactly what we're seeing across the documents we pulled today. We were looking at a massive stack of internal equipment lender guidelines, some recent trucking industry financial reports, detailed factoring rate breakdowns, and FMCSA regulatory data.
Okay, let's unpack this.
Well,
Because if you're out there running trucks, you know that the journey always starts with the iron. You absolutely cannot make money without a truck. But walking into a dealership or calling a lender, it feels like stepping into a black box. So what is the very first thing an owner-operator needs to understand about how a bank looks at that shiny new piece of equipment?
equipment financing is the most accessible product for trucking companies because the truck itself is the collateral. That changes everything about what the lender needs from you.
Yeah.
Let me walk through the documentation tiers by dollar amount because this is where people get confused.
Yeah, please do.
So Tier 1 is for equipment under $75,000. Some lenders will approve based on personal credit, bank statements, and the equipment quote alone. No tax returns, no business plan.
Oh, wow.
Yeah, if you're buying a used day cab for $55,000 and your credit is 620 or higher, you might submit your ID, 3 months of bank statements, and the dealer quote. That's it. Approval can come back the same day.
Wait, so I don't need tax returns for a used truck under $75,000?
Not always. It depends on the lender. But at that dollar amount, the truck is worth more than the loan. The collateral covers the risk. Now, if your credit is below 600, they'll want more documentation to compensate.
Okay, so they're basically betting on the auction value of the truck. What happens if I need something a little more expensive, like Tier 2?
Right. Tier 2 is that $75,000 to $150,000 range. This is where tax returns enter the picture. You should expect to provide 3 to 6 months of bank statements and 1 to 2 years of business tax returns.
Just business tax returns.
Usually, yes, along with a P&L statement and the equipment quote with full details. That means year, make, model, VIN, mileage, and all the dealer information.
Got it. And what about the big purchases, like multi-truck fleet deals or brand new sleepers?
That puts you in Tier 3, which is over $150,000. And that is the full package. You'll need 6 to 12 months of bank statements, 2 to 3 years of business and personal tax returns, a P&L, a balance sheet, and a business debt schedule.
The debt schedule, so
That's
listing
right.
every single thing I owe.
Every single loan. Lender name, balance, and the monthly payment. Plus the equipment quote, obviously. And for amounts over $250,000, an independent appraisal of the equipment may be required.
Okay, yeah.
Though below $1 million, a written estimate from an independent source can sometimes substitute for a formal appraisal.
What about the trucking specific stuff? DOT, MC, all that.
Oh, absolutely. Every trucking specialist lender expects these on top of the financials.
Great.
Your DOT number and MC authority documents, your CDL, your FMCSA safety record, including CSA scores.
Just because if you can't drive, the bank doesn't get paid.
Precisely. Those CSA scores are tracked across 7 basic categories on a 24-month rolling window, updated monthly. A satisfactory DOT safety rating is a green light. Conditional is a yellow flag. Unsatisfactory means no lender will touch you.
Man. And what about insurance? That's a huge hurdle right now.
It's massive. They want insurance certificates for commercial auto liability, cargo, physical damage on the truck being financed, general liability, and workers' comp if you have employees. Commercial auto insurance runs $9,000 to $12,000 per truck per year and went up 12.5% in 2024.
That is steep.
Very. Have your certificate of insurance ready to send before you even apply. And they'll also want your current equipment list, every truck and trailer, year, make, model, VIN, mileage, lien status, and your IFT records showing fuel tax compliance.
What about freight contracts? Does it help if I have steady lanes?
Absolutely. If you can show the lender that the new truck will have freight from day one, dedicated lanes, shipper contracts, strong broker relationships, that changes the risk calculation. It turns the truck from a speculative purchase into a revenue-generating asset with proof attached.
Okay, so you gather this absolute mountain of paperwork, but paperwork alone doesn't actually buy the truck. Let's talk about the harsh reality of credit scores and down payments.
Right, because FICO dictates the ultimate cost of your capital. If you have a 700 plus FICO, you're getting prime rates, which are sitting around 5.5% to 8%.
Okay, that's not terrible.
No, it's pretty good. If you're between 600 and 699, you get near prime rates, so 8% to 12%. But under 600 means subprime rates. And those are brutal, anywhere from 12% to 28%.
28%. That's credit card territory.
It really is. And it's not just your FICO score. The collateral rules are incredibly strict. Lenders hate older trucks. They want trucks under 10 years old with less than 700,000 miles.
Why is that? Breakdowns.
Exactly, breakdown risk. A broken truck means no freight, which means no loan payment. They know a truck with 800,000 miles is much closer to a massive engine overhaul, so they limit their exposure.
Which brings us to the actual cash out of pocket. How much do I need to bring to the table?
The standard is 10% to 20%. But if a carrier has a score under 600, they need to bring 25% to 30% cash to the table.
So basically, my down payment is an apology for my credit score.
What's fascinating here is how mechanically accurate that analogy really is. When you bring that heavy cash to the table, you entirely shift the lender's risk calculation. You're putting so much of your own skin in the game that even with bad credit, the lender knows they're shielded. It's the exact mechanism that allows bad credit operators to still get keys.
Okay, so you get the keys, you survive the equipment financing, you deliver the load, and then the next nightmare begins. Net 30 payment terms. You have to pay 48 cents a mile for fuel and 79 cents a mile for driver wages today, but the broker won't pay you for a month.
Yeah, you cannot run a trucking business on IOUs.
Exactly. Enter factoring.
Factoring is not a loan. The approval process is completely different because the factoring company is evaluating your customer's credit, not yours.
So my credit score doesn't matter.
For the factoring itself, they care about whether your freight broker or shipper is going to pay the invoice. They check the debtor.
So if I haul for a massive logistics broker, they just look at that broker's credit.
Right. They gladly buy that invoice, advance you the cash, and then they wait the 30 days to collect. Now, there are a couple of types you need to know about: spot factoring and contract factoring.
Break those down for us.
Spot factoring is transaction by transaction. It's highly flexible, which is great for owner-operators who only want to use it when things get tight. Contract factoring, on the other hand, is your whole ledger. You commit all your invoices, which gets you a lower rate, but you lose that flexibility.
What about recourse versus non-recourse? That's always a massive debate at the truck stop.
Oh, absolutely. It's the most critical distinction. Recourse factoring has a lower fee, usually 1% to 3%, but it leaves you liable. If the broker defaults, you have to pay the factoring company back.
And non-recourse?
Non-recourse carries a slightly higher fee, like 3% to 5%. That means the factoring company eats the loss if the broker goes bankrupt.
Here's where it gets really interesting, because the advertised rate on these contracts is almost never the whole story. I hear guys signing up for 2%, and suddenly their effective cost is closer to 5%.
Yeah, the nickel and diming is out of control. Factoring companies will quote a low base rate, but then they tack on ACH transfer fees, wire fees, minimum volume fees, and massive early termination penalties if you try to leave.
So how do you protect yourself?
A flat rate is what carriers should demand. You want a single, transparent percentage that covers everything. No hidden fees.
That makes sense. But factoring only covers invoices you've already earned. What if a carrier needs a $15,000 engine overhaul immediately? Or a bridge loan to survive a freight recession? Factoring can't fix that.
No, it can't. That's when you look at alternative funding. You've got working capital loans, and then you have SBA loans. The SBA 7A is a great option for established fleets. It offers prime rates.
But doesn't the SBA take forever?
That's the catch. It takes 30 to 90 days to close, and the paperwork is intense. So if you need cash immediately, that's not going to work.
And that desperation is what pushes carriers into merchant cash advances, right?
Exactly. And we really need to issue a warning here. MCAs are a systemic threat to the trucking industry. They offer incredibly fast cash, but they aren't traditional loans. They collect through daily or weekly automatic debits directly from your business checking account.
And since trucking revenue is so unpredictable, a daily debit is it's fatal.
It is. You might not get paid for 12 days, but the MCA is still pulling $400 out of your account every single weekday. The moment your account hits zero, you start bouncing vital payments. It instantly chokes a company's cash flow.
So let's say someone gets caught in that debt spiral or freight drops off and they literally cannot pay everyone. How do they survive?
If we connect this to the bigger picture, It's all about the compliance firewall. If a carrier must choose who to pay, they absolutely must prioritize insurance, specifically avoiding a Form BMC 35.
What's the BMC 35?
It's the official notice of cancellation your insurance sends to the FMCSA when you miss a payment. Once the FMCSA gets that, they revoke your operating authority. So you must prioritize insurance, IFTA taxes, and DOT inspections.
Basically, keep the authority active at all costs.
Right. You can survive a debt negotiation with a lender, but you cannot survive a revoked operating authority.
Man, that is a harsh reality check. But let's look at something a bit more optimistic. If a carrier is doing well, taking on hundreds of thousands in debt for equipment, they need to know how to get some of that money back from the IRS.
Oh, absolutely. The tax code is a massive tool, specifically the Section 179 tax deduction. For the 2025 and 2026 tax years, trucking companies can write off the full purchase price of qualifying vehicles in the exact year they are placed in service.
And that applies to big rigs, no luxury auto caps or anything.
None. Class 8 trucks are over 14,000 pounds GVWR, so they are strictly commercial equipment. No caps.
So what does this all mean? How does this actually play out with the financing we talked about earlier?
It is absolute magic when you combine it with financed equipment. Think about it. You buy a $150,000 truck. You only put down $15,000 in cash this year because you financed the rest. But you can still deduct the entire $150,000 from your taxable income this year.
Even though I only spent 15 grand out of pocket.
Exactly. Provided the truck is used more than 50% for business, you get the full deduction up front. It drastically lowers your tax bill, leaving you with more cash to fund your daily operations.
Wow. That is huge for preserving cash flow. Well, we have covered a massive amount of ground today. We've walked through equipping the fleet by understanding the lender's exact tier requirements, leveraging factoring to survive the net 30 gaps, avoiding the MCA debt spiral, and utilizing tax codes to fuel growth.
Yeah, and the overarching lesson for you, the listener, is that capital is just as important a tool as your CDL. If you don't understand how underwriters, factoring companies, and the IRS view your business, you're just leaving money on the table.
Right. You're driving with the parking brake on.
Exactly. And this raises an important question. If factoring companies and lenders base your financial health entirely on who you haul for, your broker isn't just a source of freight. They are effectively your cosigner.
That's a crazy way to think about it.
It's the truth. How well do you actually know your broker's credit scores? Next time you book a load, remember you aren't just hauling their freight. You are betting your company on their balance sheet.